Hello and welcome to the NatWest Markets podcast. My name's Imogen Bakra and today we'll be looking at the year ahead for 2020 with our global markets and strategy forecasts. But before we delve in, I just wanted to set the scene by first talking through a few of the results from our annual investor survey. We asked investors around 30 questions relating to the global macro backdrop, to politics, and really what these mean for fixed income and FX next year. Across all of the responses, we had a few key themes that we thought were worth highlighting and pointing out. So firstly, there was a lot of pessimism about global growth. We think that some pessimism is warranted, but it's arguably concentrated in the wrong places and in the wrong regions. Secondly, this pessimism on growth was contrasted with quite a lot of optimism on politics. In the US, there was certainly a bias that trade tensions would ease next year, and there was a clear consensus that President Trump will win the elections, which we think is a bit less of a done deal. On Brexit, there was a higher than we expected number of responses expecting a more softer Brexit outcome ultimately. Thirdly, there was broad agreement that central banks are out of ammunition, except for in the US, and that global fiscal policy needs to do more of the heavy lifting. We expect this to be a big theme, certainly in Europe in 2020. And finally, there was very little optimism about emerging market FX. So we'll use today's podcast to use our own analysis and forecast to expand on these key takeaways from the survey. Starting with Europe, 2019 has been a relatively underwhelming year for growth. Giovanni, why do we think that there are reasons to be more positive in 2020?
Well, I think there are basically three reasons and one more general consideration. So the first reason is that we see fiscal stimulus, fiscal easing. It's happening. It has actually already started this year after many years of restrictive policies. And we estimate that Euro area governments are collectively easing fiscal policy by around 0.5 percentage point next year, which is quite significant. The second reason is that it's not just government, but also domestic private agents. For example, households have accumulated ammunition via higher saving ratio over the past year. And companies have been destocking quite significantly this year as well. So if they don't reproduce that phenomenon to some extent next year, these components will lift GDP as well. And the third reason is that although monetary policy is probably at the end of the road in terms of action, there is still the lagged effect of what has been implemented last year. A decrease in interest rate by around 100 basis points that we've seen in 2019 will again significantly affect positively growth in 2020. So the general consideration is instead the fact that we are seeing a downgrade of the risk that we had highlighted over the year. And so if we are right that there will be a deal on Brexit, if the trade war will at least see a truce ahead of 2020, while all the positive policy impact that we've just discussed is going to materialize, then of course the situation is more positive for 2020 overall. A final risk that we mentioned is the Italian political situation. It's probably still fragile. There are still hurdles that need to be sorted out in the next few weeks and months. But if we survive this phase, which I think it's probable, then it would likely mean that the legislature can continue until 2020, even 2023. And so that, of course, frees some more calmer space for 2020 already. So overall, we're not super excited about Euro area growth next year, but we also think that there are a number of supports in place that should be in investors' mind, and that's in front of risks that, all considered, might not materialize or might materialize in their milder incarnation.
Okay. So Giles, we saw in the survey that there's a lot of pessimism about European growth, and Giovanni is clearly more optimistic. Do we think the market is pricing in these more optimistic outcomes?
Well, actually, interest rate markets are pricing quite a lot of negative news for next year at the moment, and we think that's wrong. One of the ways that you can see that is that the German government can borrow for the long term still at quite deeply negative interest rates. We think that that will turn slightly positive in the first part of next year. Most of the investors, as you said, Imogen, responded to our survey to say that they thought that 10-year yields on German government debt would stay negative, close to current levels, in fact, by the end of next year. So by comparison with that, we are expecting quite a lot higher yields, and I'm basing that partly on what Giovanni's just been saying about slightly greater optimism on the European cycle and some of those risks being taken out. We're not talking about disaster here, but we've also looked quite carefully at the long-term drivers for bond yields and the various factors that matter in the supply-demand balance in the market as well.
Okay, but what about the more riskier countries, say Italy or Spain? What are we expecting there?
Well, again, as Giovanni said, we think that 2020 is shaping up to be a less scary space for investors than 2019 was, at least politically, and it can take markets some time to adapt. For Spain and Italy in particular, we think we're in a virtuous circle of lower rates, greater political stability, and so on, which is feeding on itself and drawing in new investors. And don't forget that yields are very low everywhere, and these are two quite large markets where you can earn a yield pickup pretty much no matter where in the world you happen to sit.
Great, thanks, Charles. Okay, so switching over to the US. We've been encouraged by the recent developments. We've had positive news on trade, a still healthy job market, and equity prices are making new highs. But we're not as optimistic as others are that US growth prospects have materially improved. So, Kevin, why is it that we expect below-trend growth in 2020?
Yeah, well, many believe a trade deal will reduce uncertainty. However, we don't think that businesses will be quick to abandon their caution. First, future trade policy remains very unpredictable. And second, we fear that any reduced uncertainty over trade is going to be replaced by uncertainty over the 2020 presidential election. The policy implications of the election could be very binary, encouraging companies to maintain a wait-and-see approach to spending and hiring, and ultimately this will continue to weigh on the economy and overall top-line GDP growth.
So where does that leave the Fed next year?
Well, if the economy loses momentum as we suspect and growth performs at a subpar 1.5% pace as we expect, and with a backdrop of inflation still below the Fed's 2% target as we expect, in our view, the Fed's going to be forced to continue to cut rates. As a result, we're looking for additional easing from the Fed. We have a 25 basis point rate cut penciled in for March and June, taking the funds rate down to a range down to 1 to 1.25% by 2020, and this is certainly out of a consensus view.
Okay, so switching to the strategy side, John, what risks do you see that can bring about lower interest rates on U.S. government bonds next year?
Yeah, thanks, Imogen. And I think it's important to note that we do see a lot more downside risks, both to the economy and to yields, rather than upside risks. Economically, as Kevin noted, you have the potential spillover of manufacturing sector weakness to the consumer, as well as ongoing uncertainties regarding trade, continued U.S.-China stress, correction in arguably elevated risk assets if we do start to see U.S. growth disappointing. There's always the geopolitical side with spike in oil prices due to U.S. and Iranian tensions. Over on the European side, inability of European fiscal stimulus to revive growth. And, of course, there's the uncertainty around the U.S. election.
Yeah, so Kevin already mentioned that the policy impact of the elections could be quite binary, but how do we expect the elections to influence markets?
Well, it really depends greatly on the Democratic candidate, which we will get greater insight in late February and then into early March. The specter of a Warren presidency is very different than that of a Biden, who's more of a middle-of-the-road kind of policy outlook. If it is Warren as the nominee, markets we think are going to be very poll-driven in the latter half of the year in the U.S., based mainly on the extreme gap between Warren's more aggressive policies and just her general economic views when it comes to regulation and taxes versus Trump's. And that's going to not just weigh on the corporate outlook, but on markets.
So essentially just a year of higher volatility next year in the U.S.
Yeah, I mean, even within that trend of lower yields, we do see a lot of volatility in general, not just in bonds, but in the shape of the curve, direction, as well as risk assets like stocks. And, just as a reminder, it isn't just due to the elections. We continue to see trade even outside of China, with Europe or Trump potentially targeting other countries as an ongoing issue.
Okay, so Ross, there was quite a lot of optimism in the survey about the ultimate Brexit deal being perhaps softer than we're expecting, but we're not there yet. Will the election in December get Brexit done?
Well, the short answer is no. Brexit is a process, not an event. The deal that the UK and the EU concluded in October relates just to the first part of that deal, the withdrawal process, what we call the end of the beginning. So there are two main problems we would highlight, two main risks for 2020. Firstly, that there is no extension of the transition period. That gets curtailed as soon as the end of next year. Very few trade experts think a trade deal can be negotiated within that window. And secondly, what will be the form of the final trade deal between the UK and the EU? And here we have concerns. The deal that Mrs. May had on the table was one which saw much closer alignment with the EU than what we expect Boris Johnson to pursue. And that more divergent approach, I think, risks a harder Brexit outcome and certainly in the near term, much greater disruption.
Okay, so does that mean that we're expecting the UK to go into recession in 2020?
Well, recession in 2020 is not our central case, but we would put the risks of that at about 1 in 3, so significantly higher than in normal conditions. We think UK growth will be rather sluggish. Our forecast is for growth of just 1.3%, so not quite half the pace we had before the referendum, but a full percentage point or so below. So a meaningful slowdown on the back of weaker business investment. We also have a rather subdued global backdrop, which will hold back UK exports. But against that, there will be a couple of props. We have extra government spending coming through, and we also see the possibility for some further modest Bank of England interest rate cuts.
Okay. So Theo, how do we all tie this all together for what it really means for the interest rate on the UK government bonds?
Yeah, I think progress on Brexit and near-term optimism both will take 10-year rates close to 1%. The market is very, very pessimistic with regards to the UK economy right now. So there is this potential for an upside move higher in rates. This optimism will cover the first quarter of 2020. And at that point, the market will start to consider the longer-term implications of such a hard form of Brexit. So 10-year yields should oscillate around 0.5% in the long term, especially once the BOE cuts into 2020.
Okay, thanks, Theo. So Paul, I guess this one's for you. What do you expect sterling to do? And do you expect this to be a mirror image of gilt? And if so, where do you think the rally exhausts?
Yeah, we do think it's going to be a mirror image of the reaction of government bond markets under Ross's central case. The most likely outcome for the general election allows for the withdrawal agreement to be signed early next year. We think sterling recent recovery extends into the opening months of next year. For example, we have sterling against the dollar rising potentially to 135. Maybe it will go a little bit higher depending on what happens to the dollar, and then sterling euro up as high as 120. But I think the key message here, and this is exactly what Ross has outlined clearly, it's the final free trade agreement which will ultimately decide the level at which sterling settles down. And here the story is much less positive for the currency. So a lot of the declines that we've seen in the currency since the referendum result, we think are going to be locked in to the level of sterling against both the euro and for the dollar.
Turning to emerging markets, Olga, in your essay in the year ahead, you've titled it Goldilocks and the Three Bears. I'm guessing the Goldilocks is in reference to the supportive global financial conditions for emerging markets, but what are the three bears?
That's right. The Goldilocks refers to the best external financial conditions for the EM for the past 7-8 years. Whereas the bears refer to the bearish arguments in the market. Some of them we disagree with. For instance, the first of them refers to the valuations and buffers around EM. We think they are lower than last year, but we do think that they are still quite ample to support emerging markets. The second one refers to the fundamentals that are not improving in EM. Again, we disagree with some of them, especially the inflation is a fundamental indicator that is having a serious improvement in emerging markets with inflation expectations coming lower. The growth is another one, whereas we're seeing near-term improvement. However, we are not at levels to question or to go above the potential output yet. The third one is around the extent of the EM rebound and that it may not be persistent. For the economies that are seeing extremely slow growth, they may not have a lot of higher fiscal space, and this argument may have some merit. However, for the economies that are outperforming right now, we do think that the internal drivers are high. So this bearish argument we have some sympathy for, but not fully agree.
So does this mean that emerging market currencies are unlikely to go down in 2020?
Yes, we think that emerging market currencies will have a strong start to the year, and some of them will benefit from the uptick in global cyclical conditions, such as Korea, whereas some of them, such as Russia, can benefit from strong valuations. And of course, there are some idiosyncratic growth stories which are quite interesting, such as Brazil.
That leads us nicely onto Latin America and Brazil then, I guess. So, Alvaro, what are your thoughts there?
Yeah, for Latin American local markets, we think that the big theme next year is going to be to move away from carry to growth expectations as the big driver. And in this respect, we think that Brazil will do much better than the market expects, basically for two reasons. First, the credit channel is already expanded quite fast in Brazil because of the very low, historically low yields that we have. And second, there's the impact of the strong reforms that are being carried out in Brazil in terms of not only the pension reform, but also the fiscal, and eventually into next year, also privatization flows. Coupled with the fact that the central bank should be done in terms of the easing that they have carried out, we think that the real will do very well, and it should appreciate not only against the dollar, but also against some regional peers, such as Colombia. And let me just mention that we also very constructive for Argentina for a variety of reasons. A new administration is coming in. We think that they're going to send more of a market-friendly approach, and we think the IMF is going to be involved. So we have a very constructive view on the bonds there.
So, Jim, putting this all together.
So very comprehensive, obviously lots to digest, and I guess having either written or read year ahead documents for more than 20 years, I think there's three lessons in how you approach this process. I think first lesson is that consensus is often, if not always, wrong, and I think the good news is that we have some important disagreements with consensus and investors this year. We're obviously more optimistic on Europe, although that's not terribly hard to be. We're probably a little bit more pessimistic on the U.S., especially when you factor in the impact of the November presidential election. We probably agree with the market that the U.K. will start the year off reasonably positively, but I guess we're more worried about what happens thereafter. And I'd say we're probably more constructive on average on emerging markets than most of the consensus are. I think a second lesson around these year ahead processes is that valuations certainly on these longer horizons matter. And looking at our value dashboard in the year ahead document, there are quite a few value gaps. The dollar, for instance, starts the year very, very expensive against European currencies that haven't been this cheap in well over a decade. Perhaps not surprisingly because of the central bank policy easing last year, fixed income started the year expensive and got even more so, especially in Europe, in particular in credit. Equity valuations are a little bit more mixed, but I think the standout story there is that the U.S. equity market is more expensive than it has been any time since the 2008 crisis, and as Olga mentioned, emerging markets still have some very good value, if maybe not quite as good value, particularly in rates, as we had last year. And I guess the final lesson, not just for year ahead, but more generally, is that the market is not always great at spotting the big fundamental macro shifts. And I do think we may be on the cusp of one of those shifts, namely having had 10 years of persistent, significant monetary policy easing. We think we're coming to the end of an era. Now, part of this is simply that central banks, not all, but many, are running out of ammunition. But what's also important is that central banks haven't been particularly successful in doing the one thing they set out to do, which is to create inflation. While against that, they've been very successful in creating a lot of market distortions. What comes in place of what has been 10 years of monetary dominance? I'm probably too cautious to say it's going to be fiscal dominance, but we certainly will have a world much more focused on fiscal policy. If we get that, it could be a big game changer for markets.
Thanks, Jim, and thanks to everyone on the team. It certainly looks like it's going to be an interesting 2020 and one which I'm sure will keep us all very busy. That's all from us for now. Thank you for listening, and please do stay tuned for more of our NatWest Markets podcast.